Alright everybody, in this module we're going to be talking about buying calls. To put it simply, when you buy a call option, you're expecting the underlying stock price to rise, which will result in the option price, or premium as it's called, to increase. This means you want to trade call options on stocks that you think will increase in value. Makes sense, right? Let's look at a real world example. In this example, we'll be looking at the weekly call options. Alright guys, so for this example, we're going to be using AMC. As you can see, it's trading at about $27. So if I go over to the options here, these are all the options that are available to me. And right now, we're just gonna be focusing on the left side because that is the calls. And that means I want the stock to go up. So this is where I want to purchase. Now, this is only gonna be used as an example. I really probably wouldn't be buying the call options here just because of how far AMC is, but this will be a great example of how to purchase. So because I think that this stock can go up, I'm going to buy a call option. Now, to purchase an option is very easy. You just need to go over here and you need to select which option you want to buy. Now, when purchasing the options, I want to try and get an option for the cheapest price possible based off where the stock is trading. And if you recall from the previous videos, the options that are trading outside of where the stock price is are out of the money, and stocks inside that price are in the money. So right now it's trading at $27. So the 29 options would be out of the money. And as you can see, AMC is really starting to speed up here. So let's say I want to buy the $29 calls because I think they'll go up in value. I simply double click here, let's say 2 contracts, and you'll see right here the bid and the ask is 390 by 4. So I'll say price 415 and then hit buy to open. All right, and I just filled 2 contracts at 415. So if this, as the stock price goes up, so will the option contract. So as you can see, it's slowly going up right now. It's up to 425. So what I'm gonna do now, I'm gonna set my price here at 4.2, and I'm just gonna wait for this to this run to kind of slow down, and then I'll probably sell my option. As you can see, AMC is extremely volatile right now. It is on full squeeze mode. So these option contracts could become very expensive very quick. I mean, this thing is just absolutely ripping. We've already made, as I record this, I've already made about 10%, 10, 20%. And this will scale as this goes up more and more. So we'll keep watching this. I have my set price here at 4.2. Oh, and it's coming down. So I'm going to go ahead and sell these. And there you go. Hit sell to close. So to sell the option, all I had to do was hit sell to close here. So buy to open, sell to close are going to be the 2 buttons you use when buying an option. Now, as you can see, the prices move very quickly. So you want to make sure you have a wide risk. And when trading a stock like AMC, which is just going absolutely ballistic, you have to be very, very, very careful. You want to try and buy these options as cheap as possible during a good consolidation period. Now, you'll notice I actually sold these too soon. This is actually starting to go even higher now. So these options would have been worth 440 at this point, as you can see right here. Now, as you can see up here, these are the expiration dates. If I had bought an option further out in the expiration, they would have been more expensive. They also had lower price movements. So if you're trying to be a little bit safer and not have as volatile of option movements, you want to try and buy an option that is outside that has a longer expiration date. So as you can see with these, those 29 options are now worth $4.50. The spreads will vary. As you can see, options have a wider spread than normal. You have to be very careful when buying options, and this is why you need to set a wide risk, because these spreads can be hard to fill, which means you're not going to get the exact price, which is why you need to use limit orders all the time. So now, more importantly, how do we calculate how much we could actually make on these options? Well, here's the best way to do it. So what I like to do is I like to buy out of the money calls. And the best way to know how much your option will be worth is to see where the in the calls are trading. So for example, so let's say I wanted to buy the $34 calls because I think the stock will go up even more. Well, the $34 calls are trading between $2.85 and $3. So let's say I bought it at $3. Well, to calculate how much I would make on this, I need to look at where it is trading currently. So right now, the in the money calls is at $29. That's the very first in the money call where the stock is trading at, because the stock is currently trading at $29. So if this went up to $34, let's just say it became in the money, this $3 call option would now be worth $4.35. These options are relative. Let's say it went even further. Let's say it went up to like $40 or $50. That'd be a $10 increase. So all I have to do is take this number and just subtract 10 for the $10 gain. If we take the 29s and minus 10, that'd be 19, that'd be $10. So these $34 calls would now be worth about $10. So what you do is you would take your $3 and then find out the percent difference between $3 and 10, which in this case would be about 300% profit. All right, everybody, that covers the basics of buying call options. I hope you have more confidence now in the technical aspects of buying these options, and I'll see you in the next video to go over puts. Peace.